first year I owned a home, my water heater went out, right? And my water recirculator and my water softener. I got the whole like plumbing trifecta almost. And within a couple of years of me owning my home, we had to replace a sewer line, right? So like there's expenses that do come up, but the value in my life personally, that like me and my wife knew we were kind of staying in one place. We'd settle down, we put down roots, and we can get settled and have that stability, I think has grounded us in a different mental space as well, that maybe I would argue for me helped me be more productive in my professional career even, right?
Yeah,
so
it's stability that you can stay there as long as you want.
Mm-hmm.
How many people come to me on a weekly and a monthly basis that they would love to stay in their rental because they're in their church neighborhood, their kids are in the school districts, the whatever it may be, and their landlord's selling the house. So now they're scrambling and they have a very short window to find something.
Yeah.
And so they just kind of have to take what's there. And sometimes that isn't what they want. And sometimes it's a payment higher than they really wanted.
Yeah.
So owning a home provides the stability of staying. Mm-hmm. It also provides the stability of the expense too.
Yeah.
10 years from now, as long as you're still in that house, you may have some taxes and insurance increase, but in general, your mortgage, it's the same. Your payment's going to be essentially about the same.
Yeah.
We're pretty confidently can say 10 years from now, the rents are going to be significantly higher than they are today.
Yeah. Well,
and so the first step to owning a home isn't being a real estate investor. The first step of my job isn't teaching somebody how to be a real estate investor.
Yeah. Well, I think a lot of people shouldn't be real estate investors. Truth. Like my honest opinion is a lot of people aren't cut out to be real estate investors,
Absolutely.
But that doesn't mean that most people shouldn't be making some kind of attempt or conscious, very analytical decision about should they own some kind of real estate in the form of their residence.
Yeah. And you asked me the question earlier about down payment. I think in the right situation, somebody should absolutely buy a home with no money down. I think you should take advantage of the great loan program, especially we have in Utah, or if somebody like you is a veteran, unbelievable. Sure. Take advantage of the zero down, keep your cash.
Yeah.
Keep your cash as a reserve. I would rather have 10 grand in the bank than $200 less in house payment if I'm thinking in terms of financial safety.
I think people so often discount the value of liquidity.
Yeah, financial safety, right?
There's I think about this a lot when people, in particular right now, bringing up like the 2-1 buy downs and the rate buy downs and all this stuff. And I'm always kind of kicking myself a little bit going like, you're telling me you have like nothing else in your life that you could have taken that chunk of money and paid off credit cards or
car payment.
Hey, like maybe you only had a couple $1,000 left on one of the cars. You could have eliminated a whole car payment.
Correct.
You could have kept cash in the bank. And right now, like in the current rate environment, what's a mortgage rate today is what, 7?
Yeah.
And in a short-term treasuries, you can yield like 5.5%. So you're only on a like 1.5% negative carry, but you can maintain all your liquidity. And so someone's like, well, I don't want to pay the 1.5%. I'm like, yeah, I get that. Like, I don't want to pay any interest either. But if you give the money to the bank on your home and then you're out of work for 2 months, you don't get to go to the bank and say like, hey, I need to get some of that, equity out. Right. Can I pause payments for a couple months? Like you're going to be perpetually behind. It's tough. You can always, what does Janet Yellen always say? Take extraordinary measures, right? Fun with extraordinary measures.
So I own rental properties, and I self-manage.
Yeah.
And when we get applications, that's what I do for a living. So I'm looking at credit and income and employment history and calling previous landlords. But one of the biggest things for me is I look at how much they have in their bank statement.
Yeah.
If somebody is living on the edge, they are one breakdown, one layoff, one illness away from not being able to afford everything. Even if their credit's pretty good, but they got $500 in the bank, it could be 1 week they're out of work and everything falls apart.
Yeah.
Whereas the person that's a little bit more tight on their income, and I'm wondering, man, this is a pretty high house payment for what you make. I think maybe you're stretching yourself a little bit, but they have 10 grand in the bank.
Yeah.
I'll take that guy all day long because they can withstand a negative situation.
Yeah.
They can miss a week of work. They could probably miss 2 months of work and still pay me rent.
Yeah.
So I think people don't consider, they want to feel like it's an emotional thing. Probably they want to feel like they got the best deal they could. Sometimes the best deal you can is boring and safe.
Well,
I think keeping money in a checking account is boring and safe, or savings account. You should invest a bunch, but you got to have that nest egg somehow, some way that if crap, it's not if something's going to go wrong, it's for when it goes wrong.
Yeah. People forget, there's a crowd of people that always say, well, if you have a line of credit, it can become your savings account, right? Invest all your money.
Yeah.
Because if you need liquidity, you can use like a HELOC.
Yeah.
Right. And for people that are very comfortable with risk, right, that can be a strategy.
Absolutely.
And I have clients that do that. And I have clients that rave about that strategy, right? I mean, they're people that love efficiency. They know they got every dollar working all the time. And I tell them, like, you got to understand the risk in that strategy is that lines of credit can be closed.
Yeah.
And you don't know when it's going to necessarily happen. It happened in 2020. Wells Fargo closed lines.
Yep.
Right. There's other companies that immediately stopped issuing lines. There's been times in the past where banks have called HELOCs due, right? Like hey, not only is it closed, you have to pay it off.
Yeah.
In 60 days. Yeah. It'll give you 60 days to come up with like cash.
Yeah.
So, in a perfectly fine world, right? It seems like a really great strategy always to run cash lean, mathematically, like in a model. If you're like modeling it out and you're looking at, rates of return and yield and blah, 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 it appears to be so efficient and great. Yeah. The problem is life happens and it's really, really hard to model tail end events.
Correct.
Right. And that's why tail end events drive, it's something like 90% of the results in portportfolios is tail end events.
Wow. Yeah. Well, I think all that you should do, I think you have that safety net somewhere.
Yeah.
Couple months. What happens if your income quits coming in for 3 months? Are you going to be okay?
Yeah.
If you're going to be okay, then I think you should be efficient as possible beyond whatever that comfort level point is. The higher you are of an income earner, probably the less months you need or whatever, depending on your life expenditures.
I think it has a lot more to do with the income stability.
Yeah, there you go. That's probably it. Yeah.
If you're like if you're some specialized employee in a cyclical industry that, you make a lot of income, you have a lot of lifestyle, but if you got laid off today, it would be really hard to find another job.
I like that.
You might need more safety net than, you actually might need more safety net in that situation than say like the guy that's like a welder.
Absolutely.
Right. Like the welder is going to be like,
they'll find a job.
They'll find a job tomorrow, man.
Absolutely.
People need welders.
Great point.
And oftentimes probably has union protections even, maybe not so much in Utah, but our clients outside of Utah that are welders, probably a lot of welding,
Thinking about housing, should we talk about affordability monthly payments?
Yeah. What's talk to me about what like income, like debt to like your DTI ratio is. Yeah.
The biggest factor in determining how much you can get in a loan is essentially it's a cash flow statement for really. They call it the ability to repay rule.
Okay.
So let's just assume credit's okay. Don't have any major problems. I don't care if it's perfect or not perfect.
Sure.
Maybe you have a down payment. Maybe you're not going to do much of a down payment. The amount that you can qualify in a mortgage is based on the payment that will bring, that will have as a percentage of your income.
Okay.
It's called a debt to income ratio. Now that has nothing to do with total debts that you have. It's not you got a $100,000 student loan and it's got a $100 payment. From a debt to income ratio, the only part of that equation that matters is the $100 payment. The $100,000 doesn't go into it. So it's just cash flow, ability to repay this payment. So you can talk from a financial perspective of what somebody should have as a percentage, but I'll talk in terms of mortgage qualifying.
Okay.
You need to be, in most cases, at or below 50% on a debt to income ratio. So let's kind of just make some simple math out of that. So let's say somebody makes 10 grand a month before taxes are taken out, which is what we use on this figure.
Okay.
They have 2 car loans, 3 credit cards, and a student loan on their credit, and it all totals up to be $2,000.
Okay.
If I'm trying to keep their debt to income below 50%, there's sometimes you can go a little higher, sometimes you got to be a little less depending on down payment and credit and money in the bank. But let's just say 50%. So in that example, that person can have $5,000 in total expenditures for credit related items.
Okay.
We've already accounted for $2,000 with personal expenditures, auto loans, credit cards. That leaves $3,000 a month that they could have in their house payment. So that is the debt to income ratio. So somebody that makes $5,000 a month, has a decent down payment, good credit, and no other debt, they probably could get a $2,500 house payment. It's kind of a weird equation to think. Somebody that makes $5,000 can have a $2,500 house payment. Somebody that makes $10,000 can have a $3,000 house payment, but it's because of the other things.
It has to do with the rest of your lifestyle.